Hi, I'm Gloria Ledoux from League Info site here on the CU Compliance Connection, bringing you the Compliance Outlook for a review of compliance effective dates for the first and second quarter of 2020. We will plan to start off with all of our typical annual threshold updates coming out of the CFPB, which are predominantly tied to consumer price indices. Next, we'll spend some time reviewing the NCUA changes that became effective, including the amendments to the Federal Credit Union bylaws, the Second Chance IRPS, changes to the Supervisory Committee audit resources, and expectations, and finally, changes made to allow credit unions an increased amount of public unit and non-member shares. As part of the same-day ACH evolution, NACHA has slated for an increase in the permissible dollar amount, which we will briefly discuss. Moving right along, we also have some changes in the Internal Revenue Code, including the typical annual adjustments to the health savings account contributions. But then we have two recent law changes that impact IRA accounts and the requirement for consent if the credit union is sharing members' tax return information with a third party. Last but not least, we also have the annual changes for reserve requirements from the Federal Reserve Board. As for the second quarter, at the time we are filming this update, there isn't anything slated to become effective. However, that doesn't mean that we can rest and relax. There are still quite a few proposed rules out there that are expected to become effective. Not to mention, we have quite a bit to catch up on from the first quarter. As typical in our compliance world, things will continue to change, so we always need to be on our toes. Easy peasy. Let's start off with the annual threshold changes with a $1 increase for the safe harbor penalty fee limits for credit cards, which are now $29 for the first late payment fee and $40 for each subsequent violation within the following 6 months. For a loan to be considered a qualified mortgage and receive the safe harbor protections, the loan's points and fees must not exceed certain thresholds, in addition to other requirements. These thresholds typically increase each year. On the screen, you will see the new thresholds for 2020. Keeping in line with the qualified mortgage trend, credit unions considered small creditors are eligible for 2 additional types of qualified mortgage options, which provides for that safe harbor protection. In order for a credit union to be considered a small creditor under the rules, it needs to have assets below $2.202 billion, which is adjusted annually, and have not extended more than 2,000 closed-end covered residential mortgage transactions secured by first lien that were sold, assigned, or transferred to another person. Credit unions don't need to count loans that they retain in portfolio for this total. If the credit union is considered a small creditor under the rules, it is permitted to utilize the balloon payment qualified mortgage option as well as the small creditor portfolio qualified mortgage option. Both require the credit union to comply with the points and fees requirements, but provide that safe harbor protection for balloon payment mortgages and portfolio mortgages with the 43% debt-to-income ratio requirement. The Homeownership and Equity Protection Act, or HOEPA, governs high-cost mortgage requirements. If the credit union is originating a mortgage that is considered high cost, there are specific disclosure requirements, certain restrictions on transaction terms, fees and practices, specific ability to pay requirements, and home ownership counseling obligations. Therefore, credit unions must accurately identify if a mortgage loan will be considered high cost. Effective on January 1st, 2020, a loan will be considered high cost if its points and fees exceed 5% of the total loan amount for loans greater than or equal to $21,980, or 8% of the total loan amount, or $1,099, whichever is less, for a loan that is less than $21,980. Some credit unions may be eligible for an exemption from the escrow requirements for higher-priced mortgage loans. Each year, the CFPB adjusts the asset threshold for the exemption, which for 2020 is $2.202 billion. In addition to the asset size threshold, there are other qualifications the credit union must meet in order to be exempt. As a reminder, if covered, generally the rules require credit unions to maintain and establish escrow accounts for first lien higher-priced mortgage loans for at least 5 years. Moving right along, there are also certain appraisal requirements for credit unions originating higher-priced mortgage loans, which are listed on the screen. Higher price mortgage loans under $27,200 for 2020 are not covered under the rule and can be exempt. That loan amount is also adjusted annually. Credit unions only need to comply with the HMDA reporting requirements if they are considered a financial institution under the rules. The asset size threshold for 2020 is $47 million. Credit unions under this asset size as of December 31st, 2019 will be exempt from the HMDA requirements. In order for credit unions to be covered under HMDA, they also need to, number one, have a home or branch office located in a metropolitan statistical area, or MSA. Two, have originated at least one home purchase loan or refinancing secured by a first lien on a 1 to 4 unit dwelling. Three, be federally regulated. And lastly, number four, meet certain loan volume thresholds for closed-end mortgage loans and open-end lines of credit. If the credit union meets or exceeds either loan volume threshold in each of the 2 preceding calendar years, they are required to report those particular loans. The loan volume threshold for closed-end mortgages is $25 and for open-end lines of credit, $500. It's important to note that also effective on January 1st, 2020 was the extension of that $500 loan limit for the open-end loan coverage test, which was set to expire this year. It has been extended until January 1st, 2022. After that time, the loan volume threshold for reporting open-end loans will be $100. Now that we've finished with the annual CFPB updates, we will move on to the NCUA changes that became or will become effective in the first quarter. As we mentioned in our last quarterly update, effective on January 2nd, 2020, federal credit unions have access to updated bylaws. The bylaws were updated to define a member in good standing, which does not include a member who is significantly delinquent, caused a financial loss to the credit union, or who has engaged in violent, belligerent, disruptive, or abusive activities. The revised bylaws go on to provide examples of those types of behaviors and provide for the credit union's ability to limit services if there is a logical relationship between the objectionable activities and the services to be suspended. The new bylaws also provide options for offering different par values for classes of members, such as minors, students, or non-natural persons, provided the action doesn't violate any federal or state or local anti-discrimination laws. While the NCUA didn't approve of a completely virtual annual meeting, they did provide the ability for credit unions to have a hybrid in-person and virtual meeting. Existing federal credit unions wishing to adopt some of these new bylaw changes will need to go through the formal bylaw amendment process. Effective on January 2nd, 2020, there is a new Interpretive Ruling and Policy Statement, or IRPS, for credit unions called the Second Chance IRPS. This IRPS is related to the statutory prohibitions outlined in Section 205D of the Federal Credit Union Act. That particular section of the Federal Credit Union Act specifically prohibits, except with prior written approval from the NCUA Board, any person who has been convicted of any criminal offense involving dishonesty or breach of trust, or who has entered into a pretrial diversion or similar program in connection with a prosecution for such offense, from participating in the affairs of an insured credit union. Currently, there are de minimis exceptions to this rule that do not require NCUA Board approval. In this revised IRPS, those de minimis exceptions have been expanded to include certain convictions involving insufficient fund checks of aggregate moderate value, small dollar simple theft, false identification, simple drug possession, and isolated minor offenses committed by covered persons as young adults. Additionally, this IRPS also included a revised application for credit unions to use if they wish to pursue an exception not covered under one of the de minimis offenses. Credit unions should make sure that their human resources departments are aware of this change. Effective January 6th are the changes made to the Supervisory Committee Guide, which is being replaced by an appendix within Part 715 of NCUA regulations. Some changes include the addition to the minimum procedures for Supervisory Committee audits, which will require the review of board minutes, policies, and procedures. It will also require the testing for unrecorded liabilities. In addition, there were a few outdated audit options that were eliminated in the final rule, including the report on examination of internal controls over call reporting, which was an option to a financial statement audit for credit unions with less than $500 million in assets, and the elimination of the balance sheet audit option, which was determined not to provide sufficient information to allow a board of directors enough information to assess the financial health of the credit union. Also eliminated was the 120-day report delivery deadline for the required terms for audit engagement letters with outside compensated persons. Now, there is a flexible standard that would require only that the target delivery date allows a federally insured credit union to meet its requirement to obtain an audit each calendar year. Rounding out the NCUA changes, effective at the end of January, is the NCUA's rule allowing federal credit unions to receive public unit and non-member shares up to the greater of 50% of the credit union's net amount of paid-in and unimpaired capital and surplus, less any public unit and non-member shares, or $3 million. This is an increase from the previous rule. In addition, the NCUA amended Subpart B of Part 741 that applies to regulations codified elsewhere and applicable to federal credit unions that also apply to federally insured state chartered credit unions, thus allowing all federally insured credit unions to take advantage of this amendment, provided that they have the authority to accept such accounts. Now, moving on to NACHA. Credit unions have been transitioning to the same-day ACH requirement since September of 2016. With a three-phase process, it was easier for credit unions to slowly comply with the requirements. From the start, the limit for same-day ACH transactions has been $25,000. However, effective on March 20th, 2020, NACHA will increase the same-day ACH transaction dollar limit to $100,000. Credit unions should be aware of this change and make sure their disclosures, policies, and procedures are all updated. Starting with the IRS, the annual contribution limits for health savings accounts are adjusted annually and will be $3,550 for self-only plans and $7,100 for family coverage, which is an increase over 2019. The HSA catch-up contribution limits for folks age 55 or older remains at $1,000. Also effective on January 1st are a few changes that resulted with the passage of the Setting Every Community Up for Retirement Enhancements Act, or SECURE Act, which impacts individual retirement accounts or IRAs. Credit unions should note that changes include an increase in the age at which individuals must begin taking required minimum distributions, which is now 72 years of age as opposed to 70 and a half. Also, individuals with earned income can now make contributions to traditional IRAs at any age, removing the previous cap, which was at age 70 and a half. There were other changes that related to required distributions upon the death of an account holder and certain distribution events. So credit unions should follow up with their IRA expert to ensure that they have an understanding of those changes as well. Okay, even though this has an effective date of December 28th, 2019, we wanted to include this change in our update because it was not part of our fourth quarter video. The Taxpayers First Act was signed into law on July 1st, 2019. Within that act, there was a provision in Section 2202 that requires taxpayers' consent to be obtained prior to sharing tax return or tax return information with a third party. Credit unions that sell their mortgage loans on the secondary market, have their loans serviced by a third party, or otherwise share tax return information with a third party should amend procedures accordingly. If tax return information is being obtained directly from the IRS, prior to sharing that information, the credit union should be obtaining the member's written authorization. It appears that this written authorization does not apply if the borrower directly provides the credit union with their tax return information, as opposed to the IRS. Credit unions should also keep in mind that there isn't a model consent form currently available from the IRS. However, the Mortgage Industry Standards Maintenance Organization, MISMO, has drafted model consent language which is designed for mortgage sellers and servicers to use. If the credit union is a member, they can access the model language on the MISMO website. This consent form should be maintained in the loan file. As with any change in law, the credit union is encouraged to consult with legal counsel and develop their written authorization form and internal procedures accordingly. Last, but certainly not least, are the Federal Reserve Board's changes to Regulation D. Credit unions are required to maintain certain reserves based on the mix of deposits at the credit union. The threshold amounts for those reserve requirements adjust every year and are listed on the screen for 2020. Are we having fun yet? Let's face it, just like raising kids, compliance takes a village. Make sure you're using your resources. Support tools are typically provided for free or at a very low cost through your legal association. Are you or anyone else at your credit union taking advantage of them? InfoSite provides an overview of compliance requirements for applicable laws and regulations, both state and federal. And you can access state information for all 50 states. CU Policy Pro is our policy management system that provides over 240 model policies for credit unions to customize. We're staying on top of these regulations and updating our model policies and content within the InfoSite platform to assist you. If you aren't familiar with these products or you want to learn more, please reach out to us or your legal association. Thank you so much for joining us at the CU Compliance Connection by Legal InfoSite.